Hello guys, glad to have you on board again today. We have nothing to talk about regarding cryptocurrencies. We're obviously ranging out here. It's definitely hard to say what can happen. All I can tell is that in a 4-hour chart time frame basis, which seems to be the most reliable one to trade, I would at least wait for the 50% trend channel in order to assess that we've been neutralizing. So for now, we're still searching for neutralization. It's still not viable for anyone to buy right now, so just wait for this to lateralize. The worst case scenario will be pulling back to the trend channel, but in every cases we should never ever break down the previous consolidation area, which means for those who are really short-term aggressively playing their thing, which I still stand you shouldn't be doing. In here you've got a stop loss area to put your stop losses yourself. If we go back there, it means that something goes wrong with this thing and we might eventually forecast a triangle. But only for those who play at short term, I still stand for that. Buy and hold shouldn't even give a shit about what happens right now. Only area you guys should trade are the Fibonacci retracement, and the minimum is definitely $280, the 14.6% retracement. For those who are trading daily and weekly, okay? Remember, if you're trading daily to weekly charts, the only thing you give a shit about is this area where you have 14.6 of the overall trend retracement, bearish trend retracement. Okay, so let me just pull it back. All right, so it's this blue area. Normally we should get here. That's the minimum. All right, so long-term buy and holders, unless we get there, why the hell do you even look at the charts? It's purely and simply this. You shouldn't even look at that. So please don't, unless you're trading speculative scenario on shorter time frames like I do. If you've been taking in 1 to 4 hour chart signal support area in here or in here, you just wait for the damn thing to terminate. All right, that's it for cryptos. USD/JPY is trading well. We'll see if this one breaks down supports. We've been pulling back in here to the trend line, so it's kind of interesting to see how it's going to behave in the next following hours. If we do break down this support and reaching out in there, it's going to be validation level to me. So let's put an alert on this. I would say yes, 4 hours, great. Okay, so 4 hours not that bad. God damn it. What the hell is that? Okay. All right, so they've been updating this thing. How ugly that is. Oh, Jesus. Okay. So, no worries. That's not what I wanted to do. So let's use an alert system. So we're going to do USD/JPY, crossing, framework, trend support. All right. Arriving support trend channel. It's a validation. Oula. Arriving. Okay. So validation step means as a speculator, aggressive speculator, I'll just do nothing but lowering my stop losses and eventually forecasting some reinforcements on any pullback that could be provided. So for now I'm just waiting for this to just fall apart. So we'll see. It just depends on what Wall Street will do. We definitely have something that is changing the perception in here. If you just add the SPX on top of this, SPX has been making new highs. Definitely not on the USD/JPY, so the risk perception is rising. Gold's been rising recently as well, even though it's pullbacking right now. So we have a very different, always still the same, very dangerous kind of decorrelation systems we have, in which the SPX is trading all by itself, without volatility, without even pricing something. So it's just, yes, the US market is levitating just like that, like there is no gravity at all. So we'll see generally when this happens, it generally ends up very bad, and volatility picks up for some stupid reason just like that, because naturally volatility cannot remain low when risk markers like the USD/JPY would be about to fall apart. So we still haven't. Let's focus on that. We're still riding on top of the trend channel, so we need to deteriorate this, switching to the negative part, going all the way down to the trend support, and see how the market behaves. Normally we should get there, try the tiny pullback, fail and break down. This is normally the kind of price, statistically, is what we should see. Something like that, and bam. And then context channel as a support. All right? So this is what we may expect. Normally we should break down this low when the market will reach out breakdown. So I'm waiting for a breakout trade, but first I want to have validation, some kind of pullback, confirmation, and then the breakdown trades may occur. But right now, not for now. We just patiently wait. We see that low volume area is definitely where I want to put my breakdowns, okay? So for now, just waiting, all right? You have absolutely no choice. First thing first, we need to break down the 110 and set ourselves below that level to just confirm that the market wants to reverse. But I have a feeling that it requires Wall Street to go down, and for now, as they don't want to, we still have to wait. Talking about Wall Street, I'm not going to talk long about that, but the only thing I'm going to add since the previous analysis is that I suggest you guys have a look and put that on your chart, which is the futures contract expiration on the 15th of March. And it's definitely something that you really need to have a close look at. We're not going to change the entire view in here. I'm just giving you a broader perspective of what basically has been happening. What I've been putting in here is all the previous closes. So this is the previous close, okay? This is the quarterly contracts been closing in here, and the next week, the next quarter has been quoting this way. So it's been almost since 2016 that we've been doing every quarterly close on top of the previous one. At some point we've been going down, and as you can see, the closing price is always really important, and the market is definitely trading them. So previous quarter close has always been some support to the market or some trending thing. I mean, after some sideways action, damn, we don't even question this thing. We go straight line, oh, question, all right. But anytime we managed to have something positive, even though we had some jitters last year, it still was positive all the way through. Bam, 1st of January, not the 1st, but 21st of December, and bam, the problem shows up. Instead of rising, we're falling for once, and we're not just falling a bit, we're falling 17% out of the expiration closes. So kind of normalizing right now kind of makes sense, but no matter what, it's going to be 2 times that we break, that we close below the highs. It's rarely happened in the past, not even when we were there, not even when we were there in here. Because anytime we manage to restore some bullishness in the closes, in here, 2 times in a row we're going to close below. We're still not yet at the expiration, but we can very well forecast that we're not going to close with a high until the 15th of March. We're going to close higher than the previous close. That is definitely going to be the case, I think, unless we do have some black swan. And we cannot take that in any statistical consideration. So there, it's still possible. I wouldn't be surprised if something really ugly happened, but for now we cannot speculate on that. So unless black swan, we should have a positive quarterly close heading into 15th of March. The question is, we do have a few technicals area. We've got a very low volume area, which I think is the maximum price we can reach out to if we want to keep chasing stop losses slowly but steadily and crashing down the volatility. So I would say in here is a possibility, okay, some way. We could just try to close in here as high as we can to 28.43. Taking down all the stop losses, keep on going with that straight line, low volatile. But in that perspective, the VIX has to go below 12, not to say even below 11, which is to me difficultly possible because, god damn it, I mean 11 in terms of volatility, it's possible, but I'm not betting on this on my personal trading. Second option, neutrality. We go back to where we had some volume. We've noted this. This is the only day during the quarterly expiration that we had some significant volume just surging through 20-day average. So it's definitely meaning something. I would say we can pull back to this area, kind of of a flat structure, draw, okay, both bulls and bears were right, we're kind of closing in between, and no one is right, no one is wrong. Second option, we do have that trend line, and I still tend to believe the market is not going to break it, at least not for now, and we might have a negative bias close if we do get to close down here. So basically in here strong bears, and the bears take it over till the expiration, and in that perspective the 1st of March, which is the deadline for the Sino-American talks, and we can see it could be just a fucking sell the news. I mean, we've been buying that shit for so long, it's not that big actually. So this, and obviously I think anyway the next quarterly expiration, okay, so the one that will start from the 15th of March, and it's starting a few days earlier because there's a rollover, until the 14th of June, which is the next expiration, I think this one is going to be bearish for multiple reasons. Even if we have a deal, we're going to have negative expectation out of the earnings release, which means even with the best pricing, even with an accommodative Fed, we're still pricing corporate profits. I mean, you can't just have everything positive and just nothing negative. Remember back then we had the strongest level of uncertainty regarding the trade talks, and we had some more tariffs. So it was the worst case scenario, closely going to economic war. But what the market did tell us back then, we've got strong corporate profits, so let's price in the corporate profits and let it go with the problems about the trade war. Now the trade war isn't over for once and for all, but it could be, and even if it has to be, we'll still have to prove it, because it's going to be dangerous to just pick up the talking and thinking it's going to be truly finished without retaliations and everything like that. So if it's truly finished, 100%, great, everything's great, we'll still have to deal with corporate profits, which is having a negative guidance, and it's a kind of a problem, because now we can't have anything with a blue sky. It isn't about that. We have lots of clouds. It's just we're trying to figure out what the market wants to head to, focusing on what is blue, nice with sunny weather, or the big storm coming along the way, which is already showing some sort of lightning bursts and thunder. I mean, this is definitely thunder coming along the way, but some people want to hear it and say, okay, the storm is coming over, we better have to come back to home and have some roof to protect our heads. Or you got the stupid guys who go risk on forever, dancing down the streets, thinking that thunder will never come to their heads. It might come to the heads, as this is a pretty bad storm that could be showing up. So anyway, all right, take on those 3 risk areas if you want to have something on your charts. Doesn't mean we're going to get there. It's just consider this as magnet area. This is the magnet for bulls. This is where they take down all the bears stop loss. That's the best case scenario to them, and that will push us to make a higher close than we did previous to this one. And this to me is a game changer. This would really show a bullish bias positive thing. And the next quarter will be really interesting, because if for some reasons we find some good news, we could head to historical highs. Even though to me this scenario seems very less probable, but could still be positive. This one will make a lower close, this one, and even worse than that, which means we will be closing lower than a year ago, okay, which is important. Basically think about that for 1 year ago. Okay, it's what we call a year-to-year basis, and this is really important. So next close is going to be compared to previous March close, which is this one. So either we're going to close approximately same level, okay, which means neutrality, and I tend to believe that this is what we're going to do, because that's what the market likes, mystery. This is something you'll figure out when you've been trading for long enough, but the market likes to have options. The more options we have, the better, because it brings speculative options, and the market is now fully speculative. Therefore, what gives us the most odds and the most chances to go either bullish or bearish is always the best choice for the market. So I just tend to believe that this is too positive. We have nothing to price that. Even with a good deal, I mean, we still have negative return out of profit, out of corporate profits. So there is no blue sky in here. In here, probably just a little bit too pessimistic. We could go there. I would like that to happen, but I think that's too bearish. That's too much for the bears, and going in there will pretty much make those who are buying with the ETFs kind of panicking, because if we have a look at that, oh, god damn it, ETF volume as high as it's ever been. Great. We've been taking another 5% from the previous high. Back then we were trading 14,000. We're now 42. So great. Blue sky ahead. Who's buying that market? The same old retail traders, and that's not a good sign because VIX is still trading supportive areas, and the junk bond still showing signs of tensions out of the corporate bond sectors, which is not a good sign. Not to say there is another thing. It's not that I would like to show you bearish odds and things like that. It's just this is our actual pure cold facts. We've got half of the S&P companies who are considered as viable bonds, so no junk bonds. Okay, half of those companies are just one step of switching to junk bonds, which means half of the companies that have access to good bond prices, I mean interest rates viable for them to be sustained, half of them are nearly switching to junk bonds. The thing is that when you switch junk bonds for a company, let's take an average yield for companies. If you're not junk bonds, if you've got solid, if you've got a solid result, solid earnings, basically you're going to have less than 2%. Not going to have interbanking yieldings, far close from that, but you can have something between 2 and 3% for a company, which is pretty great. If you have a less viable balance, then you can basically expect between 3 and 5%, which is average, but definitely handleable for a company that makes profits. And then you've got the junk bonds, which is something that goes from 5 to 15%, and 15% is hell of a charge, hell of a fee for a company that makes less profits. So the problem is when the debt fees are rising, when the debt load is rising for a company that barely makes profit, or worse than that, have a negative expectation for the future, negative guidance, if you rise the debt load, you just kill that company. So there is really something at play right here, right now, because if for some reasons half of those companies on the SPX has to lose prices, has to lose profits, they will see the debt load rising as hell. So it will bring this down. And that's kind of a problem, a systematic problem, because when corporate profits goes down and the debt load goes up, that's basically a sword that just cut your head off. You can do nothing, because the only way you'll have to make profits is to borrow some money, and if you borrow some money, the interest rate will be surging, so you can't just do anything. You just have to buy, and either you wait and hope that this will just last not long enough for the investors to get the fuck out. So you take, obviously, some investors will go out, so your valuation on the stock market will obviously go down, but it can be just short term, and you're hoping that the panic will be rapid. All right? Then you're going to hold the grounds, wait for the panic to pass, and then you just hold on for a couple quarters, and then if things do great, then you're back to normal, and you just have survived. But that's how we do. It's natural selection out here, because those who don't manage well their companies, when the risk shows up, they die. And those who will do better, those who will have a better management, better cash flow, they will pick up the job others had previously. That's just how it is. I mean, we're in dangerous areas in which we put companies under pressure to see who survives. That's exactly what happens. That's actually necessary. Some people tend to believe that the recessions are ugly because so many people are losing money. Just the dumbs are losing money in recession because they are holding trades that will turn negative, or they are buying stuff that should just be sold. But it's natural. It's a natural selection process. We rise and then we burn down to ashes what's been rising to see who survives. That's exactly how life itself works, and we're thinking today that the market will just be different because the central bankers are taking this under control. Do you really believe that? I don't. I mean, to me, natural processes have always been taking over all those things. I still tend to believe there is a natural process out of the market as well, and we're going to test survivability of all the assets that have been overbought. And just right now, who the hell is buying? The same old stupid guy that will probably end up broken if my scenario triggers. Anyway, back in here because I'm still talking about that damn SPX. I'm sorry about that. I made a promise I would stop, but damn, it's hard. So anyway, take that in consideration. Is really important. So the March close, I still tend to believe for some reasons we might be heading to the kind of same close we had back then in March in 2018, just to, I mean, balance that stuff. This will be a positive bias, this will be a negative bias, but I don't nearly think we can go any further than this ground price area for the quarterly close future expiration on the 15th of March. All right, that's it. So VIX have been bought to me yesterday. I bought it 14. A previous buying entry was made nearly 15, approximately this area. Now I'm reinforcing 25% of the initial position sizing, so just a tiny bit reinforcement because those prices are interesting. I'm buying at 14, but still speculative leverage. Absolutely no. I'm waiting for validation, confirmation, you know the stuff. You should be used to that by now. Euro bounds, pretty great. I need to talk about that. So watch out for the bunds. We might do a bullish engulfing structure. I'm waiting for this to come. I'm hoping it will be the case. I still wait for this candle to close. Look at the RSI. It's been breaking to new highs with higher lows. So it's definitely suggesting that we can pull back up to the trend channel. I hope we could be able to do this by the end of the expiration, which is 5th of March in here. It's hard. I don't know. But you know how it's been, you know how it's going. If it goes there, I'm going to take a nice gain. If it goes further than that, it's even bigger. If it stays there and die here until the expiration, I'm going to have to suffer a loss because I've been, I think I bought in here and I bought in here, and the average price, my average price is nearly there, which means if we make the close on top of below 0.17 for a 10-year return on the bonds, that means I'm out on a loss with the expiration. Could be possible. That's the game, but that's how it is. If you have a look at the 1-hour chart, is where I see those things gathering some interest, because as you can clearly see in here, the market did everything it can to just hold on to this. Okay, you can clearly see that trend line. Triple top structure. Okay, so it's generally showing signs of what we call a barrier triangle. So A, B, C, D, E normally. Okay, oh, sorry about that. I'm going to do better. So A, B, C, D, E. And normally, all right, then we rise. Okay, now we've been invalidating that structure because we've been making closes below this. So this is nothing like that. So best case scenario for the bulls is just a pure range, and then we're going to rise. Okay, that's an option. Second option, we just fuck them, and then we pull them out until the expiration. Straight line, we force them out. I would pretty damn like to see that because I still don't believe that's for some reasons. It could be possible because I remind you that Goldman is selling, Commerzbank is selling as well. So we've got big names, big games with pretty much basically unlimited amount of funds to sell on a very, very niche market, very low liquid. So if they want to take it over and push the speculator out the gate by the end of the expiration, then can very well do it. And it can be just a carnage. Because if they decide to fuck up the speculators, just as a reminder, okay, the last time Goldman has been doing some kind of thing, I mean, trading against the trend publicly, it was when they bought the VIX. And just to remind you when it was, I'll have to verify that information, so it's not to be taken like that. But if I'm right, I think that's in here that they basically bought out the VIX, or I don't know if it's early January 2018 or. Oh, God damn it, I have a doubt. But at some point, Goldman's been buying, and you've seen how it happened back then. When they trigger, there's no pullback. So I think it's here. It's to be verified, okay? But that's the moment Goldman just basically made 500 millions. Let me just pick up this article. So it was February the 5th, so it was definitely there. and it was 200 millions. So it's definitely something. But as you can see, back then they've been speculating bullishly on the VIX, and they basically pulled every fucking one out. We've got some people speculating very dangerously on very low volatility. They just said, okay, it's enough, you're going out and we're taking the money. So when Goldman decides to put someone else out because they've been taking stupid risk taking, I mean, generally it doesn't end well for those guys, and I still tend to believe they're playing the same game with the BUNDs. We know they're selling, and if they want to push people out, it can be pretty fucking ugly, and it's a VIX-like kind of reversal in which there is no pullback. It's panic selling, low volatile, high volatile because of very low liquid, and if they sold. And if they want to put people out, you have to be aware that they doesn't have to buy themselves out, because it's an expiration market. If they push the price down, then only the expiration pulls everyone out. So if they want to win, and if they push those who bought out of this game, those who've been buying in here and here and here are going to have subsequent losses if we get to go down there. And that's just nothing. Just to be honest, I told you, if something really wrong happens, to me, the normality for the German bunds is pretty much at least 0.40. Not to say we could very well go trading the resistant context to straight line, which is 0.55 or 0.60. That's where we were trading back in October. So just have a look at where we were trading back in October. I mean, if they want to fuck you, we can go just there. There's a rollover in between, so I don't believe we're not going to go straight line to this, but still, I've been taking the risk. You can be damn sure I'm staying in until the last second of that expiration. I'm here, whether it's going to end up with a gain or a loss, I don't give a shit. All I know is that I'm going till expiration for that thing. If it's a loss, that's part of the game. I won't surrender. I won't fight that. I will take that loss no matter what, and I'll pay again on the next expiration. So that's how it's in the plan. Dollar is doing pretty great for the moment. It's just going sideways action. We're trying to survive. Bullish, bearish, bullish, bearish. Oh, they've been managing to do something. No, they didn't. So it's just going sideways in here. So waiting for something to happen in here. I've been taking my trade on Boeing. Not the best of a trade, as we've been managing to close at the highs. I would have liked the market to give up the gains before the candle close. So I have my stop loss in here. We go there, I'm out, and I'll stop trading. For now, I'm protected by the context channel, even though the next box should be there. Normally, I shouldn't be stopped out. I think I have, I don't know. I've been putting 5% stop loss. So what the hell does that do? Oh, I've got much better than that. So it's okay. So stop loss maybe 440, something like that. I haven't paid the best price. I think I had something like that. So 420 plus a 5% stop loss. Yes, that's approximately $440. But we go there, I'm out, and I'm not questioning anything. I just let it go with that stupid bubble if that's what the market wants to do. If we do play that divergence, as you can see, we're losing momentum. If we do reverse the support, it's going to be validation, confirmation, breakdown, and everything I want to see in here. That's pretty much it for today. That's all I've done. So buying some VIX, reinforcing the yen positions, but so far it's still not working that bad, not working that great. So oh yes, it's working for AUDNZD yen. Great, kind of a nice reversal. Oh, nice bearish engulfing structure. Another price action, divergent momentum. Wow. It's just equal. So it's just, here was the signal. This is just a stupid excess on top of this. We could be unwinding this thing. Requires a candle close, but I'm patiently waiting for this to play its game. CAD yen is playing as well. I'm looking for the reversal to play its game. I don't understand why we've been breaking those signals. They were pretty much viable. So going in here just makes no sense for the yen. It's just Wall Street's distortions once again. They don't want the yen to rise, so they've been pushing it further below. But I think we're definitely in the area. I mean, remember, 90 was the area I said we should buy. So now we're here. Why the hell would I change my mind? So I don't. I'm buying. God damn it. We got signal, trend channel. in a bullish trend channel. So I mean, buying in here, putting a stop loss there for the yens still makes a lot of sense. The rest is just a risk management. So I would say a stop loss in here is more than enough. Normally we shouldn't even make closes in there, so I would say put a stop loss in there. So the stop that was previously here, I suggest you can rise it. Below the gap. So the gap is protection, so it gives you the additional amount of money to reinforce in here. That's purely and simply this. You wait for the market to reach out to the opposite context. That's gonna basically, we may just rise like that, reaching out for the bearish trend or bearish context, and break down all of them. Okay, so it's definitely wave 1, 2, 3 unextended. This is not an extended wave. As you can see, we've been making straight line and then retracement. So even though this one was great, god damn it, that's not what I want. Oh yes, we can do that actually, it's good. So first wave, second wave with a triangle consolidation, A, B, C, D, E, and bam, second impulse, A, B, C correction. Alright, we could retrace up to overlapping. That's generally what we can do, and normally wave 5 extended to come. We'll see about that, but to me it seems like this is what we were expecting. It's a triangle, we're building the structure, and so far it's just we have something we need. We've got everything we need to go rising again, extracting from that triangle consolidation of the yen. Still speculative at that point, but I think you need to pick a bias. Mine is definitely to the bull side. Alright, that's it for today. See you guys tomorrow for the weekly candle close. We'll have a lot more to say about that. Until then, trade safe or don't trade. That still is my best conclusion. It's been for the latest few days and it still hasn't changed. Wall Street is keep on playing irrational, so let them do the shit until this returns to the mean, which means at least testing the 20-day average.